Hello, everyone. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are up today. Dow Jones is up 0.3%. Nasdaq is up 0.8%. S&P 500 is up 4%. Russell 2000 small caps are up 1%. Lots of economic data came out today. We're going to review some of them. Oil prices are up $1. U.S. Treasury yields have been volatile today, but they're pretty much flat right now. S&P 500 heat map shows NVIDIA, Microsoft, Oracle, Broadcom up quite a bit. Micron is down 3%. Healthcare stocks are down, and everything else is mixed. Let's move on to our daily article. Wall Street lifted by United Airlines strong data. Nasdaq flies to record. The Nasdaq rose to a record high on Thursday, leading to a cautious climb across Wall Street's major indices, and strong economic data lifted spirits, and airline stocks took off on United Airlines results. U.S. retail sales bounced back sharply in June, signaling renewed economic momentum and giving the Federal Reserve more reason to hold off on rate cuts as it weighs the inflation impact on import tariffs. Another pointer for the consumer health, PepsiCo forecasts upbeat results fueled by demand for energy drinks and healthier sodas, helping it offset concerns about a dip in annual core profit. The company's shares jumped 7%. Investors have already weathered a real world of mixed economic signals this week. Producer prices stalled in June, while a spike in consumer inflation dashed hopes for aggressive Fed easing. Traders now peg the odds of a September rate cut at just over 54%. Echoing this cautious stance, Fed Governor Adriano Kugler warned that rate cuts are on hold for now as Trump-era tariffs began to push up consumer prices, and tight policy remains key to keeping inflation expectations in check. Today is a day of somewhat justification for consumer health and earnings that continue to impress in a way that offer relief to markets. We're going to dig into each one of those. Let's start with retail sales. U.S. retail sales beat expectations, labor markets stable. U.S. retail sales rebounded more than expected in June, suggesting the economy was regaining momentum and giving the Federal Reserve cover to delay cutting interest rates while it gauges the inflation fallout from import tariffs. The economy's improving fortunes were reinforced by other data from the Labor Department on Thursday that showed first-time applications for unemployment benefits dropped to a 3-month low last week, consistent with steady job growth in July. The U.S. Central Bank is under pressure from President Trump to lower borrowing costs. The Fed, however, is expected to keep its benchmark overnight interest rate. For today, the message is clear, said Carl Weinberg, chief economist. The consumer is in good shape and does not need a boost from Fed rate cuts for now. Retail sales increased 0.6% last month after an unrevised 0.9% drop in May, the Commerce Department Census Bureau said. Part of nearly broad rise in retail sales last month was likely due to tariff-driven price increases rather than volumes. Inflation data this week showed solid increases in June in the prices of tariff-sensitive goods like household furnishings and supplies, appliances, sporting goods, and toys. This is an interesting takeaway right here that I haven't really seen anywhere else. Part of the nearly broad rise in retail sales last month was likely due to tariff-driven price increases rather than volumes. Still, the retail sales rebound after 2 straight monthly declines was welcome. Sales had declined as the boost from households rushing to buy motor vehicles to avoid higher prices from import duties waned. Some economists said worries of even higher prices were behind the rise in sales last month. Inflation fears may actually be boosting retail sales today as consumers make purchases before even higher prices hit in the months ahead, said Scott Anderson, chief U.S. economist at BMO Capital Markets. Auto dealerships led the rise in sales, with receipts increasing 1.2% after decreasing 3.8% in May. Building material garden equipment store sales increased 0.9%, as did receipts at clothing retailers. Online retail sales climbed 0.4%, while those sporting goods, hobby, musical instrument, and bookstores rose 0.2%. Sales at food services and drinking places, the only service component in the report, increased 0.6%. Economists view dining out as a key indicator of household finances. But receipts at electronics and appliance stores dipped 0.1%, as did those at furniture outlets. Economists said this suggests tariff-related price increases were suppressing demand. U.S. stocks were trading higher. All right, let's move on to company-specific news. PepsiCo results exceed expectations on international growth, so the demand rebound. PepsiCo reported better than expected quarterly results on Thursday, driven by steady demand for its sodas and snacks in the US and other major markets, including Europe. The Gatorade owner sounded a more upbeat tone in its comments this quarter after previously warning that heightened macro and consumer uncertainties could be a drag on its business in the US and some markets, international markets this year. I mean, this kind of goes to show that even the company management sometimes don't have a read through of what's happening macroeconomically than we do. Our business remained resilient during the second quarter, navigating through a complex geopolitical and macroeconomic environment, PepsiCo executive said in a statement. Moving on to Fed comments. Fed's Kugler, no rate cut for some time as tariff passed through to prices. The Fed Reserve should not cut interest rates for some time as the impact of Trump administration tariffs begin passing through to consumer prices, with tight monetary policy needed to keep inflationary psychology in check, Federal Reserve Governor Adriana Kugler said on Thursday. With unemployment stable and low and inflation pressures building, I find it appropriate to hold our policy rate at the current rate for some time, Kugler said in remarks prepared for delivery at a housing forum in Washington, D.C. This still restricted policy stance is important to keep longer-run inflation expectations anchored. Ongoing hiring at 4.1% unemployment rate showed job market stable and close to full employment, Kugler said. Inflation, meanwhile, remains above the FOMC's 2% goal and is facing upward pressure from implemented tariffs. That pressure was apparent in this week's CPI report that showed large price increases across an array of heavily imported goods, and Kugler says she felt that there were many reasons to think price pressures would continue to build, including the fact that the administration still seems to intend to impose higher levies on major trading partners in the coming weeks. Quote, I see upward pressure on inflation from trade policies, and I expect additional price increases later this year, she said. She estimated that coming data will show the PCE price index, which the Fed uses to set its 2% inflation target, increased 2.5% in June, while the core measure outside of volatile food and energy items increased 2.8% higher than May. Both headline and core inflation have shown no progress in the last 6 months, Kugler said. The Fed meets on July 29-30, and policymakers are expected to hold the benchmark interest rates steady. It will be the fifth consecutive meeting without a change. Since then, the President Trump's consternation focus has turned to the impact Trump administration trade and other policies will have on inflation, jobs, and economic growth. Appointed to the Fed by former President Joe Biden, Kugler's term at the central bank ends in January, creating a vacancy that Trump administration may use to appoint a replacement for Fed Chair Jerome Powell when his term as Fed chief ends in May. Other company-specific news. United Airlines reports recovery in bookings and pricing power. Shares climb. United Airlines executives said on Thursday the company has seen strong bookings in the past 3 weeks, with the carrier gaining pricing power for the first time since February. If the trend continues, they expect the company's revised full-year profit estimate would prove to be conservative. On Wednesday, Chicago-based carrier forecast an adjusted 2025 profit in the range of $9 to $11 per share. Demand feels to us like it has inflected upward and is returning toward normal trend line, CEO said. The upbeat commentary drove up company shares 3% higher in midday trade. Shares of rival Delta, American, and Alaska also rose. In April, United took an unusual step of offering 2 different earnings forecasts as US President Trump's trade war dented consumer and business confidence, making it harder for carriers to predict their business. Kirby said while demand stabilized after the pullback in March and April, it finished the first half about 5 percentage points weaker than the airline's original estimate. Passage of Trump's tax and spending bill and improvements in the geopolitical situation in the Middle East have boosted the travel demand outlook, he said. While there is still clarity on the tariff front, Kirby said most businesses now have a much better plan to deal with it. As uncertainty has declined, we've seen an improvement in booking revenue, including a double-digit acceleration in business demand, he said. United executives said the industry's efforts to slash unprofitable flights would boost airfares in the second half of the year. Kirby likened the situation to last year when reduced supply of airline seats drove up ticket prices, fueling a rally in airline stocks. From a supply perspective, it's a deja vu all over again, he said. This is almost the exact same setup that we had a year ago. Still, Kirby expects United and rival Delta to generate the bulk of the industry's profits this year, thanks to a diversified revenue stream, including premium cabins. All right, moving on. Walmart, Mexico unit wipes $3.3 billion off market value after weak Q2 margins. Shares in Walmart's Mexico and Central America unit, known as Walmex, slid 6% on Thursday, wiping off 61 billion pesos or $3.3 billion from the firm's market cap after posting weaker than expected margins. Walmex on Wednesday posted an earnings before interest, taxes, depreciation, amortization margin of 9.5%, 81 basis points below the year-ago quarter. Interesting. Amazon's AWS cloud computing unit cuts jobs. Now, these job cuts, potentially due to AI, are being led by technology companies. Amazon cut jobs in the AWS cloud computing unit on Thursday, a spokesperson confirmed following a Reuters inquiry. We made a difficult business decision to eliminate some roles across the particular teams in AWS, the spokesperson said in an email statement. These decisions are necessary as we continue to invest higher and optimize resources to deliver innovation. Several employees told Reuters that they had received emails on Thursday morning that told them they had been terminated and their computers were being deactivated. While the full scope of the layoffs could not be determined, at least one group known as specialists was affected. Specialists work with customers to help create new product ideas and sell existing products. At least hundreds of people were let go, according to two people familiar with the matter, but Amazon declined to provide a more accurate number. Several groups within AWS were part of the Thursday layoffs, Amazon said. All right. Interesting news coming out from Uber today. Uber Lucid partner on new robotaxi service, taking on Waymo and Tesla. Like I said, I think there's going to be many players in this robotaxi space, and Uber is actually turning out to be the platform of choice by many, such as Waymo and Baidu in international markets as well, and I guess now Lucid as well. Uber will purchase 20,000 Lucid EVs and use Neuro's self-driving software to power its service. So this is Uber's own service. Interesting. Uber is betting big on robotaxis with purely electric vehicle maker Lucid as its partner. The two companies, along with autonomous tech firm Neuro, announced on Thursday morning a next-generation premium global taxi program exclusively for the Uber platform. The new robotaxi program would outfit the Lucid Gravity SUV with Neuro's driver level 4 autonomous software deployed on Uber's platform and fleet management systems. Uber says the goal is to deploy 20,000 or more Lucid EVs equipped with Neuro's driver over the next 6 years. Interesting timeline. Uber says the goal is to deploy 20,000 or more Lucid EVs equipped with the Neuro driver over the next 6 years. I think this is pretty much in line with Waymo's plans, Baidu's plans, and I think Tesla will be in this timeline as well, even though Tesla hasn't really given, I guess they said 1 million robotaxis in 2020, but that didn't happen. I think it's going to be more like tens of thousands in the next 5 years. Lucid EVs will be owned and operated by Uber or its third-party fleet partners, and the service is expected to launch next year in a major U.S. city, probably Austin or some sort of California, maybe San Francisco or Phoenix, let's say. A Lucid robotaxi prototype using Neuro software is already being tested at Neuro's Las Vegas proving grounds. Lucid stock soared nearly 40% in the early trade on news of the deal. As part of the deal, Uber said it will invest $300 million in Lucid and a similar multi-$100 million investment in Neuro. We're thrilled to partner with Neuro and Lucid on this new robotaxi program, purpose-built just for the Uber platform, to safely bring the magic of autonomous driving to more people across the world, Uber CEO said in a statement. This investment from Uber further validates Lucid's fully redundant zonal architecture and highly capable platform as ideal for autonomous vehicles, Lucid interim CEO said. This is the start of our path to extend our innovation and technology leadership into this multi-trillion-dollar market. Uber Lucid Neuro robotaxi program is the latest bet on robotaxi service in the US, following Waymo's leadership in the space as the only true operator. Uber has also partnered with Alphabet's Waymo in deployments in Austin and Atlanta. And just this week, Tesla has expanded its robotaxi testing in Austin, and Musk said in the company would expand testing to San Francisco Bay Area. However, reports that just those applications for those state permits had not been submitted. Not the first time what's coming out of Elon's mouth is not the full truth. Uber once had its own robotaxi operations, but the company pulled its efforts following a high-profile accident in Tempe, Arizona in 2018. As for Lucid, the California-based company announced a strong second quarter of deliveries. No one cares. NVIDIA could recoup as much as $15 billion in revenue with H20 sales to China set to resume. NVIDIA is set to recoup billions of dollars in revenue if the tech giant resumes sales of its AI chips to China, as expected after a surprise export ban in April. Wall Street analysts at Stifel Bernstein and William Blair said NVIDIA could make up as much as $15 billion in revenue from China in the second half of the year to hit around $20 billion from the region for the 2026 fiscal year, which ends next January. That would be an uptick from its roughly $17 billion sales in China in 2025. NVIDIA said Tuesday that it had received assurances from the Trump administration that it would be granted licenses to resume sales of its H20 chips to Chinese customers, sending the stock to a record new high. Stifel analyst Ruben Roy raised his price target on NVIDIA, etc., citing the H20 news. Roy sees NVIDIA's China revenue hitting $19.5 billion in 2026. I mean, the question really is, like, are these H20 sales as profitable as H200? I doubt it. So I wonder what this means for the gross margin. Bernstein analyst sees NVIDIA raking in anywhere between $10 to $15 billion. Like, everybody's talking about revenue, but what's the impact on margins? Moving on, mortgage rates move higher again. The average rate on 30-year loan was 6.75%, according to Freddie Mac data. Mortgage rates increased for the second straight week. The average rate on a 30-year fixed mortgage was 6.75% through Wednesday, up from 6.68% the week prior. The average 15-year, no one cares, 30-year fixed rate mortgage inched up this week and continues to stay within a narrow range under 7%, which I think is going to be the case for some time. According to data from the Mortgage Bankers Association, the volume of mortgage applications fell by 10% compared to a week earlier, marking the sharpest decline in nearly 3 months. But I think that's because of the refis. Purchase applications remain sensitive to both uncertain economic outlook and the volatility in rates, and decline to the slowest pace since May. Okay, maybe not. I thought purchase applications went up, but I guess that's not true. Within the June jobs report from the Bureau of Labor Statistics pointing to strong employment and a lower chance of a Fed rate cut in July, mortgage rates are expected to remain within 6 to 7% range through 2025. Honestly, I think since unemployment rate hasn't really gone up, the Fed, I don't think is going to cut in July, maybe in September. I think it's a 50-50 at this point. And if the Treasury continues to build up its PGA account, general account, after debt ceiling was raised, mortgage rates could rise above 7%. Mortgage rates could rise above 7% in the coming months. We shall see. Some Fed officials hold firm on wait-and-see rate stance despite Trump pressure. Some Federal Reserve policymakers are not budging from their view, and rates should remain where they are despite the intensifying pressure from President Trump and his allies to ease monetary policy immediately. Federal Reserve Governor Adriana Kugler and New York Fed President John Williams both made this argument in speeches delivered Thursday morning and Wednesday night, citing the risk of inflation pressure from tariffs. With the unemployment rate, we talked about the Kugler earlier. I want to see what Williams said. On Wednesday night, Williams stressed that he thinks tariffs are already pushing up inflation and that this will increase in the coming months. He expects tariffs will push up inflation by a full percentage point. Wow. The second half of this year and into the first part of 2026. That is wild. He expects John Williams, New York Fed president, tariffs will push up inflation by a full percentage point in the second half of this year and into the first half of 2026, first part of 2026. Wild. Maintaining this modestly restrictive stance on monetary policy is entirely appropriate to achieve our maximum employment and price stability goals, Williams said. Opposing camps are now forming inside the central bank over Trump tariffs and how they should affect the Fed's rate decision. Two other Fed governors, Christopher Waller and Michelle Bowman, have argued for cuts as early as the next meeting on July 29th, 30th, which is not an outcome investors expect. Waller last week reiterated that any inflation from tariffs will be temporary, justifying a looser monetary policy approach. I think we're just too tight, and we could consider cutting the policy rate in July, Waller said, adding, it's not political. Waller's argument carry increasing weight since he's considered to be among the candidates to replace Powell as Fed chair in next May when Powell's term is up. We're not seeing a lot of tariff inflation yet, Waller added last week. For that reason, I've been arguing that we could start lowering the policy rate from our current setting. Those views align with those of Trump. On that note, thank you very much, everybody. No episode tomorrow. I'm going to be traveling a little bit for the next few days, but I'll see you next week. And enjoy your weekends. Take care.